You're very welcome to the Financial Stability Symposium.
To the Bank of Uganda Strategic Plan of 2022-2027, which gave birth to our revised mission that states as follows: to promote price stability and a sound financial system in support of socio-economic transformation in Uganda. The revamped Bank of Uganda mission emphasizes the importance of infusing both the means and the ends of Bank of Uganda's policies, decisions, and actions to ultimately benefit all stakeholders in their quest to improve their well-being.
When we talk of financial system stability, very simply it means a state of affairs where the financial sector is able to conduct its operations, provide the services that it's supposed to do in a normal capitalist economy without significant disruption.
Looking forward, we're going to require these banks to hold a bit more money. Now, the difference in terms of the capital we are increasing, we're not increasing what is called the ongoing capital requirements, the amount of capital that you must hold as a function of the assets or loans that you are making. We are increasing the minimum paid up capital, that skin in the game, so to speak, that shareholders have to put in, the actual cash shareholders have to put in, to demonstrate their willingness to be committed, one, to this economy, but also as a demonstration of willingness to support and ensure that those institutions sail through these turbulent times.
Thank you very much for taking part in this symposium. We wish you a very beautiful afternoon.
As always, before we begin, we'd like to dedicate this event, the Financial Stability Symposium, and I'd like to invite Ms. Yedida Nyakato, the Communications Department, to come lead us in a word of prayer.
Good morning, ladies and gentlemen. For the word of prayer, Father, we want to thank you for this day. We want to thank you for a gift of life. We want to thank you for Bank of Uganda and our country. King of Kings, we pray that you pardon our sins, that whatever we do, think or say should be fitting your presence. We pray that you come and take charge of this meeting, and whatever we say, whatever is being presented will be to the good of our nation, Uganda. In Jesus' name, amen.
Thank you very much, Yedida. So, without preempting the next speaker, ladies and gentlemen, my name is Ralph Akorabirungi from the Communications Department of the Central Bank, and I'll be your MC today. With me, I have a very large team of the Communications Department and other members of staff of the Central Bank who will be introduced much later on. So, ladies and gentlemen, please allow me to invite Dr. Bazinzi, Acting Director of Communications, to give his opening remarks, after which, moving swiftly, he will invite Robert to begin the presentations. Thank you.
My work will be easier today. I take this opportunity to welcome you to this second Financial Stability Symposium organized by Bank of Uganda. First, I would like to thank you all for honoring the invitation to both our online and physical attendees. Your presence continues to highlight the value and interest that you place in the Bank of Uganda and the initiatives that we have come up with over time. Allow me briefly to draw your attention to the Bank of Uganda strategic plan of 2022-2027, which gave birth to our revised mission that states as follows, quote, to promote price stability and a sound financial system in support of socio-economic transformation in Uganda. The revamped Bank of Uganda mission emphasizes the importance of infusing both the means and the ends of Bank of Uganda's policies, decisions, and actions to ultimately benefit all stakeholders in their quest to improve their well-being. One of the ways of achieving this is through effective and timely communication. The Financial Stability Forum was designed for this purpose and to shape debate around the key issues affecting our financial sector and our economy at large. So this second Financial Stability Forum particularly brings together our colleagues from the media, the private sector foundation, and other experts and practitioners to exchange views and propose ways to enhance the performance of the financial sector so that it can support the overall objective of socio-economic transformation in our motherland, Uganda. Ladies and gentlemen, today's breakfast meeting will aim to iron out the misinformation surrounding the amended guidelines and regulations of supervised financial institutions and the role of Bank of Uganda in managing cyber security in supervised financial institutions, among other issues that may come up. We shall also hear a presentation on the state of the financial sector. So this forum therefore provides an opportunity to critique and influence policy change. In his book titled Aces of Banking Industry, Hendrik Smith states that, quote, a healthy banking system is one of the vital parts of a nation's foundation. Indeed, a team from Bank of Uganda who will help us to dissect issues related to the health of the banking sector and the entire financial sector will be feeding into that historical statement that still stands true. Your participation in today's Financial Stability Symposium is therefore one way of laying a brick on the economic foundation of the nation. So we wish to thank you once again for choosing to participate in this second Financial Stability Symposium. It is therefore my singular honor to invite the Director, Financial Stability Department at Bank of Uganda, Mr. Robert Mbabazize, to come forward and make a presentation on the state of the financial sector. He will then, sir, you will then invite the Executive Director, Financial Stability, to officially make remarks and also make a presentation on the recently amended guidelines.
Good morning, ladies and gentlemen, and all people watching online. This is a very simple and short presentation whose outline is as displayed. We shall have a very brief overview of the state of financial stability using the latest data. Then we'll have a brief look at a summary of the key risks to financial stability. We'll then have a more detailed look at some of the risks. And then lastly, we shall look at the policy measures which Bank of Uganda is currently implementing to safeguard financial sector stability. I want to highlight that this presentation covers our latest view as Bank of Uganda regarding the stability of the banking system, the risks that are facing the banking system as at the moment, and also the key policy measures which Bank of Uganda has put in place to address those risks. In previous financial stability symposiums, we have started usually by providing participants with a definition or a basis of understanding what financial stability means. And I think it would be prudent to highlight for our participants today, very briefly, what does this concept financial stability mean? Because it's a very high-level concept. We want to bring it down. When we talk of financial system stability, very simply, it means a state of affairs where the financial sector is able to conduct its operations and provide the services that it is supposed to do in a normal capitalist economy without significant disruption. And in a normal capitalist economy, we expect a well-functioning financial sector to be able to link savers and borrowers, to be able to facilitate efficient transfer of funds through payment systems, to be able to facilitate price discovery within the economy, to be able to make sure that the financial markets, for example, work efficiently, the exchange rate market, for example, the interest rate market, and so on and so forth. So a financial system, therefore, which can be composed of commercial banks or other institutions like pension funds, financial markets, payment systems. The idea is that all these aspects of the financial system should be able to operate without disruption, even when there are significant shocks that could affect their functioning. So in today's presentation, therefore, we shall be focusing a lot on the current shocks that could be affecting the financial sector and looking at whether Uganda's financial system is resilient to these shocks and what Bank of Uganda is doing to make sure that the financial sector continues to be resilient to these shocks. On this slide, we provide a brief overview. And it is important to note that Uganda's banking sector remains resilient in the face of ongoing disruptions, both globally and domestically, both arising from the supply side shocks we are seeing internationally, the post-pandemic economic recovery, which we are still undergoing, as well as other headwinds to growth, which we shall cover later in the presentation. It is now well known, and Bank of Uganda has been communicating this as much as possible, that we are facing very significant inflationary pressures in Uganda, arising out of the increase in international commodity prices, as well as supply-side disruptions. Now, the rise in domestic and global inflation has led to many central banks globally, and also in Uganda. Bank of Uganda has been increasing our policy rates. So most central banks have reacted to these shocks by tightening monetary policy, which also has had the effect of tightening bank liquidity. As we shall see later, this is also affecting some of our banks, but generally the banking sector has remained resilient to this shock. There's also been a risk that as globally central banks tighten monetary policy, there could be an increase in outflows by foreign or offshore investors taking out their funds out of the country. And indeed, we have seen this in many emerging economies. In Uganda, on a net basis, we have seen some slight increase in offshore outflows. Partly, this has increased the exchange rate depreciation pressures that we saw especially in June and July. But overall, the banking sector has remained resilient, and most banks have adequate liquidity buffers to be able to absorb this risk. Having said that, credit risk remains our main concern with regard to the banking sector, especially as the central bank has moved to tighten monetary policy by increasing the central bank rate. The lending rate has also increased on most loans, which is a good thing because it shows that the transmission channel for monetary policy is working. The challenge with it is that the household and corporate borrowing costs are also doing what? They are rising. And at the same time, as we shall see in the presentation, the COVID-19 relief program, which Bank of Uganda implemented during the COVID period, allowed borrowers, not to service their loans for periods of time. It allowed banks to give some relief to borrowers. We have seen, however, that some of the borrowers who got relief at that time, their financial situation has been permanently impaired so that they cannot pay back these loans. And so banks will have to write off a significant share of these loans going forward. And also the full extent or impact of the ongoing macro shocks is yet to fully pass through to the banking sector. And when you put these factors together, you realize that, going forward in the medium term, credit risk is going to be a real concern. But as we shall see, our stress tests show that most banks have adequate capital to absorb any losses from these loans. And so, generally, the banking sector remains sound and resilient, largely due to especially the measures put in place by Bank of Uganda, including the planned increase of the minimum paid-up capital for banks, which we announced a few years ago, the implementation of IFRS 9, which requires banks to do forward-looking provisioning, and other measures which will be covered in the next presentation by Dr. Twine. Now, having covered the overview, on this slide number 4, we provide a high-level summary which looks at the direction of risk for each of the main risks that we monitor in the banking sector. We note that overall risks in the banking sector have remained heightened relative to the last time we presented to you in the last Financial Stability Symposium in June. And this is arising mainly from the macro shocks which the economy is currently experiencing, especially the heightened inflationary pressures, exchange rate volatility, although this has now stabilized in the last 3 weeks or so, the ongoing effects of the Ebola pandemic or epidemic, potential capital outflows, and concerns about the rising public debt, which has been in the news a lot currently. We're also concerned about credit risk, which, as I've just pointed out, remains elevated. NPLs are not growing. The non-performing loans of banks are not growing, largely because banks are writing off bad loans in a proactive way. They are not allowing them to grow. And also largely because of the implementation of IFRS 9. However, going forward, we anticipate that non-performing loans will increase in the medium term, which will and could affect the capital position of a few banks. Our liquidity risk increased since the last symposium. We have seen rising spreads in the liquidity markets, especially the spread, say, between the interbank rate, that is the rate at which banks lend to each other. So the spread between that rate and the central bank rate has widened significantly, which is a key marker of risk. It means that the price for liquidity in the banking sector has increased as the liquidity conditions have tightened. And going forward, we anticipate that liquidity conditions will improve as government starts to spend more, and also as exchange rate depreciation pressures ease. But a few banks could come under significant liquidity stress, especially those whose liquidity buffers are very tight. Operational risk is a big concern that we've been monitoring. All the systemically important payment systems continued to operate normally, except that in October we had a significant incident where Airtel Money experienced a very severe attack and disruption. And the third presentation today will cover some of the measures that Bank of Uganda has put in place to address cyber risk in the payment systems. Market risk remains very moderate. As I've said, the depreciation pressures that we faced in July and June have eased somewhat in November. Regarding profitability and capital, this remains good. Most banks remain profitable and adequately capitalized to absorb the ongoing macro shocks. The last risk is with regard to structural risk. And we note on this one that the share of the largest 5 banks as a share of the total assets of the banking sector has actually reduced to 57.5%. So if you add together the total assets of the commercial banks, the credit institutions, and the microfinance deposit-taking institutions, the 5 largest banks account for 57% of the total assets of all those institutions, which is a reduction from the previous period. Now, structural risk is very serious because if you have a few banks dominating the sector, it affects competition, but it also implies that the failure of any of these banks would significantly disrupt the financial sector. And Bank of Uganda has been monitoring this seriously, and last year our board approved a framework for the supervision and regulation of these big banks, which has gone a long way in addressing the risk that they pose. So leading on from that, this slide shows some of the composite indicators that we monitor that tell us whether risks in the financial sector are rising or reducing. And figure 1 is the systemic risk indicator. As you can see, especially if you look at the orange line, it shows that systemic risk remains heightened as at September relative to the previous quarter. Figure 2 is a cobweb. Essentially, it shows you which risk is responsible for the heightened risk that we are seeing. The dark blue line is the line as at September 2022, while the dotted yellow line is the direction as at June 2022. And we note from this figure that, in September, really, the main driver of the heightened increase in risk is liquidity, or liquidity risk, which I have pointed out earlier, due to the tightening liquidity in the market. And we'll cover the reasons why this is the case in the next 4 slides. Now, in the next 4 slides, I'm going to give a very high-level overview regarding some of the details on the key risks that are driving the analysis that I've pointed out in my introduction. I begin by looking at macro financial developments. And in this slide, the key things to note are that, first of all, globally, economic activity remains sluggish. There are, headwinds which together are driving central banks across the world to tighten monetary policy, especially the persistently high inflationary pressures, the supply side chain shocks arising out especially of the Russia-Ukraine war. And as a result, the IMF has reduced the forecast for global growth to about 3.2%. Now, how is this affecting us in Uganda? As many of you will have noticed, economic activity domestically also remains very soft, despite the signs of recovery that we have seen, especially since October. Bank of Uganda reduced the forecast for growth this year to the range of about 4 to 5%. Core inflation has increased to almost 10%. And Bank of Uganda has also responded by tightening monetary policy. Now, if you put all these things together, you see that the effects on the banks going forward are likely to be higher than, say, the previous period. And whereas we have seen a rise in lending rates, the full effect of these macroeconomic shocks are yet to fully pass through to the banking system, but will affect banks' profitability and resilience over the course of 2023. And this is something we shall continue monitoring. Now, banks' resilience can be measured in terms of whether they have adequate capital and whether they are profitable. On this slide, slide 7, we show that on aggregate, the profitability and capital levels of banks remain very strong. If you look at the core capital adequacy ratio of banks, it has actually improved, such that, for example, if you look at the credit institutions, their capital adequacy ratio increased from 12.4% to 15.9%. The one for banks, commercial banks, remains high at about 21.5%, which is almost double the minimum requirement of 10%. So banks and the banking sector in general remain very well capitalized, and this has enabled them to absorb the ongoing shocks that we are seeing in the economy. And the strong capital has been supported by improved earnings, whereby we see that commercial banks' interest income especially has improved and grew by about 8% compared to the previous quarter. But also we have seen a reduction in the cost-to-income ratio of banks. And why is this important? Because for most banks, losses arise out of very unsustainable operating what? Costs. So a reduction in the cost-to-income ratio enables banks to improve their income and also build capital. And most of the reduction in the cost-to-income ratio has been on account of a reduction in loan losses, but also the increased adoption of digital channels for delivery of financial services. This is also driving, a reduction in costs. The other indicator of bank resilience is whether banks have adequate liquidity buffers. As they say, liquidity is the lifeline of a bank. Okay? Banks need liquidity to operate on a daily basis. Capital is used to absorb losses, but on a daily basis, banks need liquidity to pay out deposits, to transact. And our indicators show that liquidity in the banking sector remains strong, even though if you look at the overall picture, funding conditions and the cost of funding tightened during the quarter. So if you look at the liquidity coverage ratio, for example, you'll see that it remains above 100%, and as at September was about 170%, which is a very good level. And all the banking institutions met the prudential liquidity requirements. There is no bank that is not compliant with the liquidity requirements. Having said that, as I pointed out at the start, partly as a result of the tightening of monetary policy, the cost of funding in the banking sector increased during the quarter, especially the interbank rates. And if you look at the spread between the interbank rates and the CBR, it widened, as you can see in figure 7. Having said that, with the easing of exchange rate depreciation pressures that we have seen during November, we expect liquidity risk to ameliorate in the next quarter. Now, I want to touch briefly on credit risk. First, credit growth remains subdued and has not picked up since the last symposium, largely reflecting the muted growth of the economy, but also reflecting, antipathy by banks about lending within the current economic environment. However, asset quality, which is a key indicator of credit risk, improved actually. So if you look at the ratio of non-performing loans to total loans in the banking sector, we see that the NPL ratio actually improved during the quarter of September from 5.4% to 5.2%. We anticipate, nevertheless, that going forward, the NPL ratio is likely to pick up, largely due to the soft economic growth, impact of inflationary pressures, and also the need for banks to write off this large volume of COVID-19 loans, whose performance remains very problematic. Because many borrowers who got credit relief during COVID period, many of them have been unable, not many, some of them have been unable to fully recover. And on this point, I want to give an update on this COVID-19 credit relief program. This is our final report on this program. The COVID-19 relief program, which Bank of Uganda implemented in April 2020, achieved its objectives because it enabled borrowers, as well as banks, to get some relief during the lockdowns at that time, whereby you could go to a bank and they allow you to spend some time without paying your loan. Now, if you look at the performance of the program, we see that about 40% of the total loans in the banking sector benefited from this program. And in shilling terms, this amounted to about 7.6 trillion. Now, as at September 2022, when the program ended, of the 7.6 trillion that benefited, only 1.8 trillion was still under the program, meaning that the vast majority of borrowers who benefited from the program resumed payment of their loans successfully and exited the program. The overall program ended in September 2021. Bank of Uganda at that time, however, extended the program for just the education and hospitality sectors, which at that time had remained under several prolonged lockdowns. Now, within that extended period, as you can see in the box on the left, the credit relief that was granted to education and hospitality sectors alone in the year between September 2021 and September 2022 amounted to 53.2 billion. So many institutions in the education and hospitality sectors were able to use that extension successfully. Table 1 shows the amount that is still outstanding broken down by sector. And in that table, you can see that education is under the community and social services, about 330.8 billion. But the largest share of outstanding credit relief is to construction and real estate. And then trade and commerce being the third, which is not surprising because the hospitality sector is reported under the trade and commerce sector. So overall, the program was successful and it has now ended. Going forward, as I pointed out earlier, our main concern remains those loans that benefited from the program, but where the borrowers, their situation was permanently impaired by COVID, and now we're also experiencing the ongoing macroeconomic shocks. So the ability to resume normal payments remains a challenge. In total, the loans affected amount to 1.1 trillion, which is about 5% of the total loans. Bank of Uganda has been continually engaging commercial banks to ensure that they monitor these loans and set aside adequate capital to write them off if the case arises. And our stress tests show that most of the banks are able, as of today, to absorb any losses from these loans. And we shall continue to monitor and take action. I want to touch very briefly on market risk. Market risk basically covers exchange rate depreciation pressures, interest rate risks, and so on and so forth. We note that despite the exchange rate depreciation pressures that were witnessed, especially in June and July, most banks continue to operate within the regulatory net open position limit. Foreign currency loans to total loans remain well within the limit of 80% and were at about 59%. And the indirect and direct impact of this risk to credit risk remains very minimal. Regarding real estate, real estate is very important in the financial sector because it forms the collateral for most loans and forms the main financial asset for households and corporations. So any changes in the prices of real estate affect the performance of households, the borrowing capacity of households and corporations, and also the risk that financial institutions take on. Now, the data from the Uganda Bureau of Statistics shows that the residential property price index continued to oscillate and that prices reduced by about 12% in the year, September 2021. This is a big concern, which we continue to monitor. Other incidental indicators show concerning trends regarding commercial property, especially reduced occupancy rates, as well as volatility in commercial property prices. Now, whereas we have very good data regarding residential property prices, there remains a gap regarding data on commercial property, especially on prices, occupancy rates, and so on. So the Bank of Uganda has embarked on working with the Uganda Bureau of Statistics to compile data on occupancy rates for commercial real estate, and also to compile a commercial property price index, which we hope to begin in 2023. Now, as I said at the start, when we look at the financial system, we not only cover financial institutions like banks, which I've just covered, but we also cover payment systems and operational risk. This slide touches on some of the indicators regarding payment systems. However, later on we shall have a presentation by the Director, Payment Systems Department, which will cover all these indicators in more detail. So if you'll allow me, I will leave this part of the discussion to that session. And the next slide as well touches on regulatory developments. Dr. Twine will touch on that in his presentation, which is coming right after mine. So I want to conclude, therefore, by highlighting some of the measures that we've taken. I highlighted earlier the risk regarding concerns from the movements in real estate prices. And at the last meeting of the Financial Stability Committee of the Bank of Uganda, which was about a week and a half ago, the bank decided to maintain a limit on the loan-to-value ratio for residential property at 85% in order to mitigate excessive leverage by borrowers and also guard against the risk of adverse movements in property prices. We also maintained the counter-cyclical capital buffer at 0%. This is a buffer that banks would have. It's a buffer of capital that banks would have set aside if credit growth was growing faster than what we anticipate or what would be required. As we've seen at the moment, credit growth remains subdued, so this buffer is not required. We've also embarked on working with the Uganda Bureau of Statistics to compile a commercial property price index and compile data in that area. And we're also going to work on a loan-to-value ratio limit for commercial real estate to complement that of the residential property. And then lastly, we know that macro shocks, filter through and affect the banking sector, usually with a lag of about 6 to 8 months. And so Bank of Uganda will continue to monitor the ongoing shocks, and we have engaged and will continue to engage banks to make sure that they set aside adequate liquidity and capital buffers and set aside adequate provisions for any loans, bad loans, on an ongoing basis and on a forward-looking manner. I want to stop here. Thank you very much for listening, and I hand you over back to Ralph. Thank you very much.
Okay, ladies and gentlemen, please welcome Dr. Twine, Executive Director of Supervision.
Today, what we're going to look at is the changes to regulations within the sector that have occurred since our last symposium. And the reason why I focus on this is that, with all due respect to the press here, is that there's a tendency to misinterpret deliberately or otherwise without bothering to read the actual regulations or legislative changes and make potentially damaging conclusions. The first one I'm going to start with is the Microfinance Deposit Taking Institutions Amendment Bill. So the Microfinance Deposit-Taking Institutions Act has been in place since 2003. That's a good 19 years. But the business of MDIs has changed over that period, both in terms of the kind of customers or the demographic they serve, and even the nature and the type of services they provide. So, briefly on July 4th, Cabinet considered and approved the draft amendment bill and authorized the Honorable Minister of Finance to take it to Parliament for the legislation enactment process. Yesterday, 22nd of November, the Minister indeed did present it for first reading on the floor of Parliament. And for those who doubt it, we can present you a copy of the order paper. I know I'm dealing with the press, so I have got to be very careful. So the key highlights of this amendment. One, up until this point, MDIs were not allowed to use banking agents. So one of the things that this law does is now enables MDIs to use banking agents. So it means that the coverage, as it is, most MDIs tend to have a wider coverage because they focus on a demographic of the population that tends to be generally underserved or having limited needs or hard to access. So by allowing MDIs to also offer their services, be it deposits, loans, loan repayments, statements, and so on, and even account opening through agents, it means that potentially with the current network of about 11,000 agents, it potentially means that MDIs now, their spread in terms of the services has expanded. And this goes to speak to the financial inclusion mandate that was assigned to Bank of Uganda under the Financial Inclusion Strategy 2017-2022, where we're talking about improving digital infrastructure. Two, currently banks, commercial banks, that's Tier 1 and Tier 2, which is credit institutions, are able to provide bank assurance services. So, in other words, we want to move to a dispensation where the provider of you have more or less a one-stop center. The person that provides you your banking services, depositing, loans, withdrawals, can also provide insurance services. Allowing MDIs to do this means that we are expanding the potential coverage for insurance services in this country. And for this, we had worked closely with the Insurance Regulatory Authority. Third, Islamic finance. Islamic finance, despite what it actually says, is really about, it's more or less ethical finance. The idea that something like this is coming, we had an amendment to the Financial Institutions Act in 2016, we had regulations in 2018, and now there are some small changes we intend to make to finally be able to operationalize it. It is where you have more or less transparency or partnership between the lenders and the borrowers. Because Islamic finance is based on one fundamental concept in terms of how they look at money. Under conventional banking, money has an intrinsic value. So if I deprive you of your money, I must compensate you for that period of deprivation, right? Which is what you call interest. In Islamic finance, money has value to the extent it can be used to acquire an asset that then generates an income. So money itself is not value. Money is not useful. It's only useful to the extent that it can acquire an asset or be used to acquire an asset, and that asset generates an income return. So in that case, it becomes valuable. So you see the slight differences in terms of the intrinsic value associated to money under the two different dispensations. So largely, those are the three things. Of course, naturally, MDIs will be able to use to report to the credit reference bureaus. We also bring in the other amendments we have done, which are purely for a supervisory point of view, in terms of their reporting and our ability to further supervise them in detail. The second is the MDI Registered Societies Regulations. At the passing of the Tier 4 and Money Lenders Act, there was a provision, that was in 2016, there was a provision that for SACCOs, or Tier 4 institutions, that are of a certain size, and I believe it's with savings in excess of 500 million shillings, or capital of 500 shillings, for capital of 500 shillings and member savings of 1.5 billion shillings. That those were to be regulated by Bank of Uganda. The rationale for that position was that at that point, that circle has become very large, okay, and should no longer just be treated only as a simple circle. In other words, it has acquired, to use the words of Robert, it has acquired an aspect of systemic importance. So these regulations lay down the regulatory framework under which Bank of Uganda shall be regulating these, we're calling them large circles. These regulations were drafted together working with the Minister of Finance and the First Parliamentary Council. And I'd like to report that as of this morning, actually yesterday, but as of this morning, not only were they approved and gazetted, they were actually published yesterday. So now the actual regulations are available, and we are hoping that by the end of this week, they shall be available on the Bank of Uganda website. Again, when you look at what these regulations do, first of all, they clearly define the roles in terms of where the Register of Cooperatives and Bank of Uganda, where our roles start and end. So a circle would have to be first and foremost registered with the Register of Cooperatives, okay? And that's for its establishment. Then Bank of Uganda comes in and says, because you have acquired a certain size, we now are going to take over with regards to your supervision and regulation in terms of how you conduct your business and how you relate with your members. The third one is the CRB regulations, or Credit Reference Bureau regulations, 2022. So these were gazetted on the 30th of September, and they were actually published. Again, also yesterday. The final copies are out and they shall be shared with all stakeholders, and copies also made available on the Bank of Uganda website. There are two key things in the Credit Reference Bureau regulations. One, before, only deposit-taking institutions were allowed to submit information to the Credit Reference Bureau and to receive crediting history or usage information from the Credit Reference Bureau. That was narrowing the pool of people who could use these services. So we're finding a situation where someone has credit with, say, a money lender or some other microfinance under UMRA, but his or her performance on that loan is not captured in the Credit Reference Bureau information. And if they have never taken a loan from the formal financial system and they now go and apply, they look like they're a new borrower with no history. But if they were not performing the other end, the financial institutions had no way of knowing. So what we had was a situation where lenders had only a partial picture of a lender's usage and behavior with credit, which partly explains the kind of pricing and the high interest rates we see. Because one of the things we have since realized as Bank of Uganda is that the cost of credit, the cost of borrowing in Uganda, is also significantly affected by something in finance that's called information asymmetry. That when you sit in front of a lender, they have no way of objectively assessing your ability to repay, or more importantly, your willingness to repay. Why? Because they can only see a part of your behavior and usage of credit. What this regulation now does means we are expanding beyond just those who provide financial credit. The regulations now expand the whole universe to even those who provide what is called trade credit. Your utility company, Umeme, National Water, your landlord. Because your landlord is essentially providing you credit. You stay in the house, you pay at the end of the month. Though there are other landlords who insist you pay before the month begins. Okay? Anyone who provides any form of credit, any company that provides a service for which you enjoy the service and pay after you use it, is technically a creditor. So all those, landlords, utility companies, car dealers, anyone who wants to provide any credit in any form, be it wholesalers, all can now provide information to the credit reference bureaus and also be able to get information from the credit reference bureaus. This is what it means. It means that now, how you use your credit, whether you meet your credit obligations on time, is going to determine whether you continue to receive credit from others. So if I defaulted on my loan, it might make it complicated next time I'm going to move and trying to find a place to rent, because the landlord should be able to pull up my report and look at how I've used credit in the past and decide, I think you're too much of a credit risk for me, I think I'll pass. What that does now is that we're reducing the information asymmetry, the difference in information about borrowing capacity and willingness to repay to those who provide this credit to us. And the intended consequence of this, the objective of this, is that now pricing for credit is going to begin to reflect each and everyone's individual credit profile. If me and you, two of us, we have the same income, right? We want to enter or start a similar project. If we walked into a bank, the interest rate that we will both be given is approximately the same. But if you have been good at paying your credit in the past, why should you pay as though you were a potential bad borrower like me, who has maybe defaulted in the past? Now, with that scoring, with that kind of information now, when lenders are lending, one of the forms of collateral as an individual you're going to have is your credit score or your credit history. So your credit history is going to become commoditized, it's going to become collateral. The other part to this is that subsequently, we're also going to move away from the financial cards. So your national identification number becomes your unique identifier. So the moment you have a national identification number, you automatically have a credit file, even though it will be empty if you've never taken any credit. So then every time you're interacting or paying your rent on time, or your utilities on time, or your phone bills, or you buy a car and you're making installments and you're paying them on time, all that gets reflected and begins to create a credit profile of you as an individual. And by the way, this also applies to companies, except for companies, they won't use NINs, they'll use the registration number with URSB. The other part is that besides expanding the scope of people whom can provide information to forest bureaus and receive money from credit reference bureaus, is that now both negative information and positive information about your usage of credit is going to be recorded. In some jurisdictions, and we have a neighboring country that has a similar problem, where there's a tendency for the credit reference bureaus to only report the negative information. When you fail to miss a payment, that's what they capture. What these regulations are saying is that they're providing for the capturing of both negative and positive information. And the best way to reflect that means that we now are going to move to scoring. As opposed to just a report, each of us who has a NIN or a company that has a registration number is going to have a score. So we're moving to scoring, credit scoring. Now, there are three credit reference bureaus. They will have their own algorithms in terms of how they determine their scores. And one of the things we're putting in these regulations requires us to be able to look at the algorithms they use to compute your score to make sure that if one credit CRB says that Martin is a good borrower, the second CRB shouldn't say Martin is a bad borrower. So this provision, I think it's regulation 24 now, also creates for something called a central data hub. So all these people who now can start submitting information about your usage of credit, whether it's financial credit or trade credit, will be submitting this information to a central hub where all the credit reference bureaus will have access to the same information, pull it out, you apply the algorithms, and then develop a score for you. So if you're in the top 10 percentile of good borrowers in one credit reference bureau, you should also be in the top 10 best borrowers in terms of scores across all the CRBs, so that there's comparability between your scores. So one CRB might have scores that range from 100 being bad, and 900 being very good. If you are at 850, you are in the top 10. Another one might have from 400 to 700. So you should also be somewhere north of 630, say maybe about 650. So that's what we mean about comparability. Besides just expanding, It also means we're moving away from the FCS card to the national identification number. It also means we're moving to scoring. Yes, reports will still be available. But for those who are lending or making a credit decision, it is going to become much more easier. Now they have an objective number. For all of us, I believe everyone here at least has gone through school, at least O level. You know, they tell you, get 95%, that's an A. But you get 91, it becomes a B+. So everyone is going to have a score, and that will reflect their credit worthiness. What does this mean? What's the implication of this? And what's the upside to this? It means that every time you stand in front of a potential provider of credit, they now have an objective way, they have a number assigned to you based on your past behavior to determine your credit worthiness and to determine whether or not, one, they want to deal with you, and two, how they will price credit to you. So in this case, it means that when a bank is lending, or a financial institution is lending, your pricing, me and you, should reflect our credit worthiness, how we have used credit in the past. Of course, someone might ask and say, but now if it's the first time I'm doing it, I won't have a score. Granted. But then you have an opportunity, and then we'll talk about it, we have an opportunity now to begin putting in place programs to enable people to begin creating their own credit profiles. On that, I thought I'd even use this opportunity to make a reference to something that appeared in the papers recently. I think it was James Tamele, a lawyer, who put out an interesting article, and unfortunately, I believe he misinterpreted or misrepresented certain facts. So when you look at the gist of that particular article, and it was tied to this credit reference to Euro regulations, remember, they have only been published when? Yesterday. The article came out 2 weeks ago. So what was he talking about? His arguments were based on the draft. But let's even leave that. So his I would say, thesis of his argument, of his article, was basically founded on two premises. One, that Bank of Uganda had overextended its authority by issuing, was engaging in something he called rulemaking. Now, rulemaking within regulatory terms is about creating regulations. You do rulemaking when you have a primary act, and then you decide you want to implement aspects of that act, and then you issue a rule. That's a regulation. But in Uganda, each and every act that's ever passed by Parliament has specific provisions on how regulations are created under that act, okay? And to the best of my knowledge, and that's why we're doing this, we have not violated those. So his first premise that we had taken on rule-making authority, whereas we're not being given that authority by Parliament, is actually incorrect. That every regulation or guideline or circular that we issue is either provided for in the act or in the regulation to that act. Then the second premise was that by directing or guiding, actually it was directing, that all loans should have a national identification number attached to them. That we're delegating our authority as a regulator to another agency. I believe every one of you in this room has a cell phone. There was a directive, and I was privileged to have been at UCC at the time, that directed that all SIM cards should have a NIN. Did it mean that UCC delegated its authority to NERA? No. Because by an act of Parliament, the Registration of Persons Act of 2015, NERA is the sole agency established for one sole purpose: the identity, the management of identity of citizens and non-citizens in this country. So it is the one source of truth about our identity. So all we were doing was telling the banks that, look here, in any case, every account has a NIN. Every account, most accounts have a phone number attached to them, which also has a NIN. Let us complete the circle. Even the borrowers should have a NIN. Okay? So I don't see, and perhaps if I would like to have an interaction with him on a one-on-one, I would like to understand what he was thinking when he thought that we are delegating authority. No, we are merely saying we're actually exercising authority by directing alignment of everything to a nil. Because when one reads the Registration of Persons Act, I believe it's section 66, it actually specifies that the national identification number is mandatory. It's not optional. It's not a nice to have. It is mandatory for things like access to financial services, registration of a title, registration of things like getting a passport. Okay? Very soon it's going to become a requirement for you to receive government services as a citizen to be able to have a national identification number. That way we are reducing the possibility of non-Ugandans enjoying services that are meant for Ugandans. So what we're doing merely is aligning with what every other agency in this country is supposed to be doing, ensuring that our national identification numbers, those unique numbers that identify us, have the information about us. And in any case, NIRA is the best agency that has to maintain and keep that confidential information, because they've been doing it up at this point. They have your fingerprints, they have your parents' names, your parents' names, their villages. What these Credit Reference Bureau regulations are doing is that we want to move to a dispensation where it is possible for you to walk to your bank and get a loan on the strength of your credit profile, your credit history. That's the first step, and a very necessary step in financial inclusion. There are those persons who would like access to credit. They don't have collateral, but they have a track record of how they have handled credit in the past. And on the basis of that, someone should be able to enter into a transaction with them. And one of my colleagues is going to come and talk about payments, and he might touch on fintechs. But now just think of what it means for the fintech industry. For the fintechs that want to get into lending, for the fintechs that want to start providing insurance services, they now will have the ability to be able to make a decision and provide credit to people who have been formerly financially excluded without having to look at what collateral you're holding, but rather focus more on your usage of credit in the past. The assumption is that your usage of credit in the past is a very good predictor of how you use credit in the future. And I'm not saying that as human beings we follow normal distribution in our behavior, no. But I'm saying as a starting point, whoever chooses to engage in a credit transaction with another, by being able to get their national identification number and look at their score, you have a starting point, at least an indication of whether they are good or bad as a counterparty in a credit transaction. I think those are all the regulatory developments that I can talk about. There's one I will not put up on the screen, but which I believe we mentioned the last time, and I would just like to provide a further update. And the Director of Financial Stability made reference to it. It's on the increase in the minimum paid-up capital for banks. He told you that banks are resilient. They have the capital today to deal with the shocks that they have faced as of today. As a regulator, we don't focus only on yesterday and today. We also ask ourselves, if we look at what's happening, we look at the existing geopolitical tensions both within our region and internationally. We look at where we think inflation and the responses to inflation by the other central banks is going to be around the world and what the impact is going to be on our economy. We look at how our economy is doing. And the other day there were papers, there's something in the papers about the amount of debt the country has, what this means. We then said, looking forward, we're going to require these banks to hold a bit more money. Now the difference in terms of the capital we are increasing, we're not increasing what is called the ongoing capital requirements, the amount of capital that you must hold as a function of the assets or loans that you are making. We are increasing the minimum paid-up capital. That skin in the game, so to speak, that shareholders have to put in, the actual cash shareholders have to put in, okay, to demonstrate their willingness to be committed, one, to this economy, but also as a demonstration of willingness to support and ensure that those institutions sail through these turbulent times. Because we don't want to end a period of turbulence. And whereas the government should be finding money to provide services and maintain services to the public, the money is being diverted to bail out financial institutions. So the way you avoid that, one of the ways you avoid that is the shareholders, please show your commitment to your institution. Literally, so to speak, put your money where your mouth is. That amount is increasing from 25 billion for tier 1 commercial banks to 150 billion. For the tier 2, it's moving from currently 1 billion to 25 billion. And for the tier 3s, the MDIs is moving from $500 million to 10 billion shillings. Even if we were to just adjust for exchange rate depreciation over the period of time, you see that the increments are not that significant, especially when you look at where the economy is today and where it was 20 or so years ago when these changes when these capital requirements were put in place. So, ladies and gentlemen, largely, that's my submission for today. Okora, I don't know if we are allowed to take questions at this time?
Not yet, sir.
Not yet. Okay. But thank you very much.
We've already seen Dr. Twine. We have Robert, who's the Director of Financial Stability, giving us a presentation earlier on. We have Dr. Bazinzi, who's Acting Director of Communications. We have Ivan, Director, Non-Bank Financial Institutions. Sophie, Acting Director, Commercial Banking. Martha, who's representing Director of Petroleum. Don, who's representing Director of Economic Research. And we have Sarah, who's representing the Deputy Director of the ICF. If you're staff of Bank of Uganda and I haven't recognized you, please note that you are one of us, and we are here as staff. I also haven't been recognized by myself. Ladies and gentlemen, please feel free to have a bit of coffee while we get settled for the next presentation. Thank you.
Good morning, ladies and gentlemen. I will share a few thoughts with you on the role of Bank of Uganda in managing digital financial risks. You've heard, in fact, I'm happy that I'm coming last because I think the context has been set very well from what you heard from Robert, Director of Financial Stability, and Dr. Twine. I will borrow a few things from what they've shared, but I think their presentations set the context very well for what I'm going to cover. We have seen significant or rather accelerated developments in terms of adoption of digital financial services. And I think the COVID pandemic specifically, turned out to be an opportunity in disguise when it comes to digital financial services. We've seen accelerated adoption since the pandemic. And, that is one of the benefits that I guess we'll talk about coming from the adverse developments of the past 2 years. However, of course, with those developments come risks, and indeed, digital financial risks have continued to feature prominently. There was the case that Robert cited, but there are so many others that may not necessarily have made it to the media around, cybersecurity breaches and systems breaches. So, in my presentation, I will highlight 3 broad themes. First, some general developments around digital financial services. A little bit in terms of legal matters, legal and regulatory aspects, a bit about the threats, which I think we've all appreciated already. And then I will end with some policy interventions. What is it that the central bank is doing? What is it that is planned? And what is it that has already been implemented? This slide kind of lays out the interaction between payments, fintechs, and the conventional banking. The past few years have, kind of increased this interaction between these three variables, or these three arms. Conventional banking has continued to rely on fintechs to deliver not only the banking, traditional banking products, but also emerging aspects around payments. We see things like digital remittances, gaining strongholds. The traditional remittances, for example, where someone has to walk into maybe a Forex bureau or a Western Union agent and get money, are kind of dying away. Today we see remittances, which are a key source of livelihood, by the way, for a good number of people in Uganda. So these remittances are now, say, going straight into the digital wallets, mobile wallets, or into bank accounts directly. We see payments around utilities. The Executive Director Supervision has just talked about umeme, or utility companies. Gone are the days when you have to line up at an agent point for national water or umeme to pay in cash. Okay. These days you can pay off your mobile wallet. You can instruct your bank to make that payment, and that is a transaction that is in the background, supported by a fintech player. There is an aggregator behind there. There is an integrator behind there, and these are key players in this revolution. On the other side, we see the role of fintechs coming through strongly in things such as digital credit. The credit reference regulations that the Executive Director has just talked about are heavily enabled by fintech, or fintechs for that matter. Okay. The credit scoring, the guys that are running the algorithms behind there may not be the conventional bank that you see, from whom you are probably taking a digital loan, or it may not be the money lender, the credit-only microfinance institution that is supervised by, say, UMRA, that you see on the face. There is many times a player in between that is supporting the credit scoring. There is a player that is supporting the credit profiling to enable the credit decision to be taken. So digital credit is an area where fintechs are playing a key role, but also an area where fintechs and banking are interacting heavily. Pensions, insurance, healthcare, and all sorts of innovations are things that continue to reflect the role of fintechs and the growth of digital financial services. This slide throws some light on the digital payments, but for the wholesale systems. I know this may not be of a lot of interest, to the ordinary Ugandan, but what I've highlighted in red is something to take note of in the context of the discussion we're having. And this is around reduction in check transactions. Whereas we see significant increases in the wholesale payment systems, RTGS, EFTs, the checks have posted a reduction, and this is of up to 4% in volume and 7% in value if you take the year ending June 2022. This tells us that there is increased use of digital payments, and this is partly attributed to the policy initiative implemented by the central bank to cap interbank check limits effective January this year. So for that year ending June, the check payments in the interbank funds transfers accounted for about 9% only. Now this slide is on mobile money, and I won't labor much, but it is just to show how much growth has been registered in terms of mobile money over the recent past. If you take the year ending June, transaction values went up by almost 38%. And we're talking about 156 trillion in value, transacted over mobile money in 12 months ending June. And if you bring it forward to September, which numbers are still under validation, it even gets higher. September is hitting around 160, for the 12 months ending September. So we see significant increase in mobile money transactions, both in terms of volume and value. And this is attributed to, of course, public adoption of digital payments. The public seems to be yearning for more of these faster payment options, but also use cases. We see a lot of innovation coming through, especially with the licensing of more players in this area. We see use cases that continue to emerge. We see, digital payments or mobile money, if you want to call it so, being adopted in public transport. You've probably heard of companies like Safe Border. Safe Border is a licensed payment service provider. The company trades as such, but it is the real entity is called Genestech, which is rolling out, a wallet to support public transport in the border motorbike sub-segment, but also in a taxi. They've rolled out something called, I think, Safe Taxi, which you might have interacted with. So these use cases are very, very promising in terms of meeting the increasing public demand for safer and more efficient digital payments. You might also have seen Tondeka buses. Tondeka buses are also intending to use a payment option championed by one of the recently licensed digital financial services providers. So generally, there is increased adoption on the mobile money front, and we hope that this will continue as we aim to move towards a cash-light economy. The other retail system that I would like to highlight is the agent banking platform. Now, I would like to qualify my comments and emphasize that I'm talking about the shared agent banking, okay, not the general agent banking model, but just the shared agent banking in which the banks are sharing a network of agents. In the year ending June, transaction values went up by nearly 30%, while the volume went up by half. And we're talking of almost 10 trillion in transactions being conducted on the shared agent platform. Okay, that is the interbank agents only. 10 trillion in a year, and that is 30% up in comparison to the same period ending June 2021. So this is another retail payment system for which we see increased adoption. Of course, the deposits retain the majority of the transaction value at 77%, which points towards how important this is in terms of deposit mobilization, especially in the hard-to-reach areas. The other systems or options include the debit and credit cards, which have also generally posted growth. There is, for that same period, June 2022, we see an increase in the transaction volume for credit cards, even though the active cards went down. So the increase in transaction volume and the increase in transaction value indicates, increased usage by fewer clients on the credit card front. But if you move back to the debit cards went up by 20% when compared to June 2021, and the value went up by almost 20%. Even though the transaction count went down by 10%. So a little bit of a mixed position when it comes to the cards, but the internet and mobile banking statistics, bring out the context even more clearly, because in the 12 months ending June 2022, internet banking nearly doubled. Okay, it nearly doubled to over 80 trillion. We're talking about 80 trillion being transacted on internet banking across the different financial institutions. And in terms of mobile banking, this posted, more than, double growth to 164% increase, ending at 17 trillion for that same period. So on the whole, we see significant uptake in terms of digital financial services. And indeed, like the Director of Financial Stability indicated, this partly explains some of the other indicators, such as the reduction in cost-to-income ratios for the banks, because these options are cheaper and easier to reach out, especially to the rural communities and the peri-urban areas. But having highlighted, that growth, on the dark side, we see increase in the threats. We see an increase in the risks that come with these transactions and these digital financial services. And at the top of the risk landscape is the question of operational risk. Operational risk is one of the risk categories that is most prominently impacting on this very promising growth and adoption of digital financial services. We have seen this cut across the financial sector as a whole. It's not a risk that you could peg to payment service providers or payment system operators, the aggregators alone, but also the banks as well. Like you've seen in the statistics, internet banking has grown to 80 trillion within the 12 months ending June. Mobile banking has grown to 17 trillion, reflecting 160% increment in value. So the question of operational risk is something that keeps us awake, looking at the financial sector landscape in totality. And this is being driven, of course, by cybersecurity. The Airtel incident is one of the recent cases, but there have been so many others that haven't been reported. The amounts may be much smaller, but they reflect, the vulnerability that comes with digital financial services. There is the question of digital fraud. This digital fraud is as basic as someone calling you and, telling you, or saying we've sent money to your phone in error and please send back, if they could say we've sent you 100,000, please send back only 20,000 and retain the 80, and we've seen these cases happen. So this digital fraud is something that is of concern as the market grows. This could be a barrier for even further adoption. And of course, people are taking advantage of the low levels of financial literacy, but also, I don't know, sometimes we tend to look out for quick wins, We tend to look out for quick gains where we have not sold anything. I've had cases of people being asked or being told that they've won money in promotional events that they've not even participated in, But because of the excitement, because of the search for a quick win, we many times, fall to the pranks of the fraudsters. Identity theft. Identity theft has been one of the issues perpetuating digital fraud, especially through SIM swaps. You might have seen in the newspapers yesterday the Executive Director, Uganda Communications Commission, commenting on the same issue. So there is some fraud around SIM card identity, and so the public is urged to, safeguard your details, safeguard your national ID details, and don't, just avail them to anyone anyhow. Because through these SIM swaps, people, use false identity, obtain new SIM cards, and then they're able to perpetuate some fraud, either on mobile money, but also on banking apps, okay? Because when someone gets your credentials, then they could be able to compromise some bank account details through the USSD access channels. There have also been a few cases of system downtime, which could be denial of service attacks or, general operational failure. And this is something we've noticed on a few occasions. The other area is around third-party risks, outsourcing of services to partners. If you go back to my second slide, which had the interaction between banking, fintech, and payments, it tells you that there are so many partnerships that enable the delivery of these services, and through those partnerships, there is a lot of outsourcing of different aspects of the business model. But outsourcing comes with certain risks, including continuity of operations, things around data privacy and protection, and related matters. Of equal importance is the question of cloud services, cloud computing, and use of cloud solutions remains an area of interest. Of course, it comes with benefits in terms of cost, in terms of access to very recent technologies, but it also has its own challenges, including system access in times of crisis, and being able to guarantee the protection of the data that is held in cloud. The other issue, which I think is something I've already commented on, is around the low levels of digital literacy, and there is increased use of social engineering to perpetuate most of this fraud. And I will later on highlight what is being done about that. Now, on the legal and regulatory front, the previous speakers highlighted most of the recent developments, but I will emphasize maybe 2 or 3 regulatory developments that have occurred in the recent past, which speak to the question of risk around digital financial services. I will speak to the National Payment System Consumer Protection Regulations. These regulations were gazetted just a couple of months ago, September 9th, but they lay out certain provisions around risk management, particularly in the context of consumer empowerment and consumer protection. For example, payment service providers are now required to proactively educate their customers on cybersecurity and risk in general. Okay, they're also required to implement certain measures, certain other measures to ensure the robustness of their internal controls, particularly around consumer empowerment and consumer data protection. The central bank also issued guidelines on the operation of trust accounts. These guidelines have laid out specific responsibilities for trustees who oversee the funds that are set aside as backup for the digital money that you transact with off your wallets. The credit reference regulations, the executive director supervision elaborated on these, but the point I want to emphasize is around the system robustness provisions. The credit reference regulations, of course, have opened up the credit market to fintechs and other accredited credit providers, but they have some very, very key provisions around the robustness of the systems used to process the data, the robustness of the systems used to run the credit scores and related aspects. So this is partly addressing some of the threats that will come with an expanded credit market. The increment in minimum capital, paid up capital for the banks and other institutions, again, this has been addressed. The capital, as we know, improves the institution's ability absorb these risks and related shocks. Now, what are the other measures being implemented? Some of these measures are laid out in the e-payment strategy that Bank of Uganda is running with for the next 5 years. I will skip number 1, the legal and regulatory framework. I've already highlighted what is being done on that front. Strengthening of payment systems oversight. This is ongoing work. Bank of Uganda is strengthening the oversight, and I will highlight some of the ongoing measures in that regard. But allow me to, for now, talk about promotion of infrastructure aspects. One of the things the central bank is doing to again strengthen, consumer protection and related aspects is data replication. In the current arrangement, mobile money data is replicated at the partner banks that hold the trust accounts. However, this is changing with the central bank set to replicate all the mobile money transactions at the central bank. So in case of breach, in case of a challenge, it will make it easy for the central bank to reconstruct that data or even have access to it on a real-time basis to ensure business continuity. The other initiative is around the National Switch project. Whereas the primary benefit of the National Switch is systems interoperability, it comes with add-ons that will enable the financial sector to have centralized cybersecurity standards, centralized technical standards. We're talking of ISO, for example, ISO compliance. So by having a centralized switching platform, the financial sector as a whole will be able to leverage these centralized capabilities, including cybersecurity standards, including AML aspects, and of course, we hope that this will deliver the business value for the customers. The other area is around consumer protection and stakeholder collaboration. For consumer protection, I've highlighted some of the ongoing works, including the recently gazetted NPS consumer protection regulations. But there is a lot of work that is happening around stakeholder collaboration, like I'm going to highlight shortly. Now, that said, I would like to emphasize that when it comes to mobile money and similar digital money that is issued privately, all that money that you see in circulation, all that money that you have in your wallets is fully backed up with cash. Okay, so even if one of the players went down, even if a player got a breach of I don't know what proportions, the digital money, the mobile money that is circulating is fully backed up by cash. And as at end of June, a total of 1.7 trillion was held by the different banks as backup for the privately issued mobile money that is used within the ecosystem. In fact, as of September, the figure even went further up to 2 trillion, in terms of cash, hard cash that is held in the bank accounts. So all the money, all that digital money that you see in circulation is fully backed up by cash in the banks. And this cash is not intermediated. This cash is not intermediated, by the banks. It is held in liquid assets, okay, which could be hard cash, it could be fixed deposits, or government securities, okay. But otherwise, all that e-money in circulation is backed up by cash, and there is no need for worry, even when we see some of these incidences. And then 2, I talked about the guidance on trust account operations. We've worked with the market and we've guided them on how to oversee these accounts. But the point probably I will emphasize is that this money that has been set aside is not even overseen directly by the e-money issuers or the mobile money operators. Bank of Uganda has required the market to set aside a team of trustees who have direct responsibility over these funds. So it is not only set aside as a backup, but it is also overseen by an independent team of people who have clear obligations, clear reporting obligations to the central bank. Bank of Uganda has issued some guidance to the PSPs on the need for enhancements around cybersecurity. Cyber defenses need to be enriched, but also general systems resilience and risk management in general. And this is, I guess, ongoing work because the threat landscapes continue to change. So we continue to offer that guidance to the market. But there is also a requirement for the institutions to conduct systems audits, at least on an annual basis. But of course, like I said earlier on, the threat landscape continues to change. So Bank of Uganda requires these institutions, the payment service providers, to do an annual systems audit every year. And for the banks, it happens every 2 years. We are currently, evaluating whether an annual requirement is sufficient, given the evolving, nature of the threat landscape. So probably, after further consultations, this could be revised in terms of frequency. But we are also working on specific details around the minimum provisions for what these systems audits should cover, particularly for the payment service providers. But then the other provision, which I will speak to, is the encouragement. We encourage the market to take advantage of the regulatory sandbox to test, innovations before they are rolled out into the market. The regulatory sandbox gives the practitioners the opportunity of testing the innovations in a live setting with limited access to the ecosystem. And then through those tests, through that testing, you are able to identify some of the possible challenges and then plug the gaps before going live. So this is something we are actively promoting, and we hope that the market will take advantage of it, both for potential new entrants, but also for the existing players as they test their solutions. The other things that we're doing relate to consumer empowerment. Bank of Uganda is stepping up its consumer empowerment campaigns, especially through digital literacy. We've seen that the weakest link are the individuals. The weakest link is the individual in this chain. And so we are stepping up digital literacy campaigns to empower the population, to empower the masses, especially since we've seen that most of the fraud is perpetuated through social engineering. Now, social engineering, builds or is built on two, those individual vulnerabilities, and so digital literacy is a key intervention we are pushing through. The bank is also working on cybersecurity guidelines, both for the conventional financial institutions, but also for the PSPs. This initiative is taking a regional approach under the auspices of the ESC. So after the partner states have agreed on the minimum for the region, we'll see this customized to suit our Ugandan environment. And hopefully that will happen in the short term. Stakeholder collaboration. Bank of Uganda is also stepping up stakeholder collaboration. You will have seen, you probably saw in the papers recently, the bank renewing and revisiting its memorandum of understanding with the Uganda Communications Commission. So a lot of work is going on between the two institutions, particularly on matters such as SIM card fraud and related matters. As you know, the communications infrastructure is under the oversight of the Uganda Communications Commission, while the financial services are under the purview of the central bank. However, the digital financial services, in many cases, are delivered on top of the communication infrastructure. So the two authorities have revised their memorandum of understanding, and this will be an avenue through which some of these risks are addressed. Of course, NIRA is the other party we are working closely with, particularly around identity management. You heard from the Executive Director Supervision earlier on the question of using national IDs for identifying financial services consumers and collecting of credit performance data. So we are working with these authorities to ensure that the sector is more robust and that these incidences are put to bed. There are also think tanks that Bank of Uganda has set up, still under stakeholder collaboration. The bank has fostered the formation of a Payment Service Providers Association as a lobby group, as a policy think tank for non-bank payment service providers. And there is a lot of work going on under that forum. But also, there is an apex committee at financial sector level, which is constituted by the Uganda Bankers Association and the PSPs. So through the auspices of these forums, some of the ongoing works relate to minimum integration standards between, say, a bank and an aggregator. What should be the minimum, in terms of technical standards that a payment service provider or an aggregator should have before they are permitted to have access to the ecosystem. What is the outlook? In terms of outlook, we think that operational risk will remain high and with an upward trajectory. Reason being that, the digital literacy remains low, and yet digital financial services have a bigger bias in terms of the retail scene. Like you saw in the statistics, the growth is much higher on the retail scene, and indeed that's very good for us as a regulator because we want to move to a cash-light economy. Okay, but because of the low levels of digital literacy, operational risk and related matters will remain high with an upward trajectory. But the central bank will continue engaging the sector, not only the banks, not only the PSPs, but the financial sector as a whole, for further strengthening, for further shoring up of the risk management frameworks and operational risk defenses. Financial literacy efforts will continue, and like I said, with a heavy bias towards digital literacy. We are currently in the phase of developing the second national financial inclusion strategy, and the inception report that has been delivered by the team taking the lead has already identified digital literacy as a key theme as we move into the second national financial inclusion strategy. But overall, the funds remain safe. Like I said, all the e-money that is in circulation is fully backed up with cash held in the banks, and this cash is not intermediated. It's set aside as required by the regulatory provisions, but also that cash is overseen by independent people. A payment service provider must designate independent persons who are constituted into a trust as a corporate entity of its own for purposes of providing the investment advisory services and the oversight for those funds. So we urge calm and assure you that the payment service providers remain well capitalized and the operational risk exposures remain under regulatory oversight. Finally, this is our aspiration. We hope, that, as we push towards a cash-light economy, we'll be able to empower Ugandans with a broad range of innovative e-payment options which are safe, efficient, accessible, and inclusive to promote socio-economic transformation, as you had in our revised mission statement. So that is it. I thank you and will welcome discussions as shall be guided by the moderator.
So ladies and gentlemen, that brings us to the end of our presentations. We are now going to go into a Q&A session. As I said earlier, please, if you're watching online, please put your questions in the comment section and we'll get back to you. It would also be helpful if you told us where this question is coming from, who you are, which organization you represent, and who you are addressing the question to.
Thank you for the presentations. I saw there were new things coming up and certain things have to be clarified. I begin with Doctor. Doctor, I looked at your presentation. I just need some small clarification. And in that area where you talked about Islamic banking, there was a word missing there. I don't know whether that is the plan, because you put it under MDI, Islamic banking, okay? But it didn't appear in the fully fledged commercial banking. I saw it missing. Then the other thing that I would also like you to address is in the area of, let's use tier 125 to 150. I know we are moving towards the deadline, perhaps. I don't know whether you are getting what is the updates? Are you getting the updates from these institutions? Are they progressing? I think that's the question. Are they progressing? The other day I saw somebody say that made 70. Then where I was seated, I added 70 plus the 25, maybe it was meaning, it comes to something like 95, and somebody was talking over 100. And I was wondering, how does 70 plus 25, I thought it's 95. Anyway, it is somebody's calculation. I'm just giving it as a reference, but I just need that update. Are you making a follow-up? Are they making progress towards that? And then also, when you come to the CBR thing, which you talked about. Now, when you look at all those things, how effective will this scoring issue? How is it going to affect the borrowers really? Sometime, okay, let's give an example here. I borrowed. Maybe I borrowed 100 million, something like that. But I borrowed it maybe once for a long period of time. And then I may not be a frequent borrower all the time. Won't that weaken my scoring? I just borrowed once, one time borrowing, 100 million. But maybe when I go back after maybe 1 year or 2 years, how does that grow my scoring line? I think that's what I need to touch on. Normally when I get this, I ask the questions because sometimes I may forget to come back. Robert, let's go back to somewhere. I will begin with that area of the lag behind, because you talked of the lag of about maybe 6 months to 8 months. But I was wondering, why is it that when the central bank makes a pronouncement in the changes of the CBR, the response on the side of the banks also to increase, it goes so fast. It is like they don't wait to see. They have not finished the other one, again they go and increase. And yet the lag is about, you get it, 6 to 8 months. So I think the period of response is very, very short, very close to each other. Now, I think that one, you will put it there. When we go back again and I looked at the credit risk, there are 3 things that you showed there. And one is about the property, the residential property. And I saw it was, you mentioned, it was 12.9, right? I think it was 12.9. And I was wondering, would that really trigger into a high levels of non-performing loan to that area. Since people feel like, I think that is an area everybody has to build anyway. Whether it is empty or not, they have built, it is there. Then there was also something which I wondered. When you look at the papers, almost every day you find properties are on auction. But when you showed the NPL, again, surprisingly, it came down. And thinking outside there, they are thinking it is rising. So what could have contributed to that difference? There was a difference there, which was remarkable anyway. So I was wondering. Now, where is Andrew? When I looked at all those things, the threats really, and you put all the guidelines. I mean, what you are planning to do, but educate us here. How are these guys really protecting their what? Their could we say clients really? Is there a regular kind of interaction between these new service providers that you give them license to educate them? Because the point you mentioned there is one of the legal, I mean, the low level of dignity of what? Literacy. So maybe my thinking is that maybe you could also advise these guys maybe to have some kind of public education to their clients. Things are changing every day, so you must also do that, and we see how it comes. But this time, last time you mentioned something. Today you didn't mention different, I mean, the growth, the percentage growth. I think you only showed the one of the shared banking and internet banking. But when you look at the whole payment system, okay, you mentioned something also about the checks coming down. What about the others? The percentage of growth this time is somehow, I don't know whether you forgot, because I was looking at I was looking at it, and you stopped at what? You stopped at June. So there was a space. I think you deliberately left it out from June to September, something like that.
Mine is in relation to these Ponzi schemes we see. In my lifetime, I've witnessed quite a number, like 5. But all these Ponzi schemes are incorporated. They are banked. But each time Bank of Uganda comes up and issues a statement, we do not know that scheme, how it operates. Everything seems to vanish. I think evaporate. There's no track, there's no what. Is there a way we can track the money that has been put in those banks, and you publish, like, say, now, like recently there was BL2 football where billions evaporated. Is there a way how Bank of Uganda can publish, like, okay, this is how much they collected, since they are banked through the financial institutions you supervise, and this is how much was recovered, so that the public can ease, you can ease the pain of the public.
Okay, do I have any more questions in the room?
Thank you. My name is Joshua Mushwa. I'm from the Government Citizen Interaction Center. Mine is really a simple one, and it's about the CRB regulations. Is there a platform where individuals can easily check and find out their credit score, or is it left to the financial institutions to determine whether you're good for the money or not? Thank you.
So we have one more question.
Thank you so much, Bank of Uganda, for first of all inviting PSFU to be part of this discussion. I have a number of questions and recommendations to raise. One is on the issue of non-performing loans. Data of Bank of Uganda, I think by April this year, was showing a tune of about 240 billion in non-performing loans and about 1.004 trillion in repayment areas of the loans. And we now see, based on what was presented, about 1.1 in areas, and I didn't get clearly how we stand in terms of non-performing loans. But also there is data that is showing the liquidity in the banking sector remains strong. And we again tend to see a competition between the private sector and the government in terms of borrowing, government getting money from commercial institutions, which in a way discourages the private sector from, the banking institutions from lending to the private sector, given the guarantee of repaying back the loans, but also the increase in the rates in itself also discourages the private sector. So in your fiscal policies, how are you making sure that you're actually, on the other hand, taking care of the private sector to access finances, but also to grow, because we see a lot of businesses closing because of course, effects of the pandemic and the fact that they are unable to pay back the loans. Then the other question I want to raise is on the question of safety and data privacy. I think as a country, we need to begin thinking about how we encourage, or as even government, how we make sure that data is aggregated into probably one institution. And because it still baffles me why I should take a photocopy of my ID to a banking hall when I have an ID card, and I've even submitted an in to the bank to open an account or hold an account with the bank. But still, I need to present a photocopy of my ID. So how am I sure that that data, same to mobile money agents and whoever. So how am I sure that even my data is protected, and those are not the same agents who end up sharing that data? So then scammers get to know Julius has this and this amount of money on his mobile money account, and then they begin to send me messages and so on, and people fall prey to those scammers. Then the other one is on stakeholder collaboration, and then policy think tanks, and probably that leads into the low digital literacy. Now, we had a discussion with the Bank of Uganda's PSFU on how we can collaborate to make sure that, first of all, some of the policies that come out, but also how they affect the private sector, but also how the private sector gets to know about those policies, but also ensuring that their ideas are heard. I know sometimes when the central bank is coming up with fiscal policies, you're more looking into stabilizing that fiscal regime, but it's also important to have an input of the private sector in terms of how that is going to affect the entire economic growth. And we had opened a discussion on, for instance, having an MOU with Bank of Uganda, also to think around how we can collaborate in making sure that we promote more of digital literacy and other aspects, such that there is a close interaction and collaboration between the private sector and the central bank. So maybe I think from this meeting we can again revive that conversation and think around how we can bring both the private sector and the central bank together. Thank you.
Bank of Uganda to allow other identifiers other than the NIN, like a passport and other documents. First and foremost, the Registration of Persons Act, which is a law which is not under Bank of Uganda. It is a law purely under the National Identity Registration Authority. Section 66 lists mandatory services for which a NIN is needed. Bank of Uganda does not even have the power to waive those requirements. All we are doing is ensuring that the things we do, even though we have a law that we are responsible for and that governs how we conduct ourselves, we ensure that our licensees are also in compliance with other laws in the country. That's one. Two, and I remember this argument that this person has just brought up, was the same argument that happened in 2015-16 when we had the exercise of ensuring that all phone numbers had national identification numbers. And there was a whole argument of saying people should be able to use a passport. But if you're a citizen, what is a passport for? A passport is merely a document that allows you to pass through a port. That's why it's called a passport. Okay? A document that enables you, that gives you passage from one place to another, cannot be a document that we're going to base on to rely on for your identity, especially when you have an agency established by Parliament, by an act of Parliament, whose responsibility is the management of the identity of all persons legally residing in Uganda. So, unfortunately, on that one, Bank of Uganda don't have the power for that. That waiver, if that person seeks it, they should appeal to NIRA and see if NIRA can waiver a provision of its law. Yes.
Badrun Tege, I'm a board member at PSFU. Clarity on that one. I agree with the concept of the NIN, but it's the practice that we also need to clean up.
Okay.
Banks are insisting that somebody brings a physical ID, yet we know that there is a bit of a delay in young people being able to get a physical ID. Yet I can get a passport with a NIN without a physical ID. So my passport has my NIN on it. It is a legal document. So at least, as long as I have the NIN official letter from NIRA, the bank should accept that, unless we're saying that we don't trust the NIN letter. Else, we should create a mechanism that the bank can check whether that NIN letter is valid, authentic. What we find is we find a lot of young people that have just come into earning, into workspace. They need to actually have a bank account so I can pay their salaries. They don't have the physical NIN. They don't have an account. And they keep on telling you, pay my salary in his account. And that creates these other problems. So maybe saying, as long as you have the NIN, the banks should allow that account to be open, even if it's under a temporary condition, but the account should be opened.
Yes, my good friend Badru, and I agree with you, but here's the problem. If a person walked into a bank and had written their name on a piece of paper, oh yes, even if you have an official letter, we all know what NASA Road does. Okay? You see, what we are actually beginning to realize, because for your information, by the way, banks actually have access to verify identity interactively online with NIRA. Okay? What we're trying to do to enhance that checking is also to add an image, so that when you walk in and open an account, most banks will ask you for an ID number and the NIN. The combination of those two uniquely identifies you. But then we've been seeing frauds that are perpetuated where people have taken a copy of your NIN, of your ID, get the NIN and the ID number, but superimpose an image. And the banks now find themselves having to deal with those kind of frauds. So as a safeguard, they're saying, for now, no, until we have, NIRA has given us that ability to be able to, when we send a NIN and a card number, to send back a confirmation that those two exist, but add an image, so that you complete the whole process of identification. So while I understand the pain and the discomfort that causes, it's because we have seen frauds that have taken advantage of that small loophole. No, so yeah. So now I am aware that right now there's an ongoing discussion between the Uganda Bankers Association and NIRA to fast track that, because the APIs for exchanging the NINs and so on exist. It is just a question of just adding on some extra functionality for an image to be sent back. That's a much faster way. It's taken a bit longer, but based on your comment, I shall actually go and follow up with the Bankers Association to see how far they have gone on that ability.
Okay, thank you. Doctor?
Yeah, the next one, the collaboration between PSFU and Bank of Uganda. That one we've taken note. We are going to fast track that. There is the issue of data safety and privacy. I think that was about, within payment services, and I'll ask Andrew Kawere to address that issue. On the issue of, where you say that every time we increase the CBR, we're actually making it difficult for businesses, we are aware. But then we find ourselves as an economy in a difficult situation. We're coming out of a period of inactivity. We're trying to recover as an economy, okay? Then we have all these external shocks and geopolitical tensions, which they are not of our doing. We're not involved. We have no say in Russia, Ukraine. We have no say in M23 and whoever else they're fighting. But unfortunately, the impacts of those tensions are affecting us, okay? And then we have inflation. So now the question becomes, we want to save the businesses, but we need to control inflation. Because see, once inflation is a dangerous thing. Once it crosses a certain threshold, which more often than not is not really known, it becomes what in economics we say, it gets anchored. So what are the consequences? You have dollarization of the economy. Your currency becomes worthless. The process and the pain would have to go through to restore confidence in our own currency and in our own economy. We are better off bearing some pain today and keeping the inflation in check and not having to worry about the bigger pain down the road. Okay? But I think the rate of financial stability will add on to that. There was the issue of someone asked about a platform for where they can check the CRB scores. Like I said, the regulation was only published yesterday. It was gazetted on the 30th, but publishing the actual physical thing that now is going to become publicly available was done yesterday. Even if we were miracle workers, we wouldn't have that information available for you now. However, Bank of Uganda, with the Credit Reference Bureau Association, with the 3 CRBs that form an association, together with the Bankers Association, is going to work out some kind of awareness. First of all these people who now can provide information have to be aware and made aware of what is available to them now and how they can use it. There will also be specific arrangements on the users or the consumers of credit, the individuals like me and you. Because someone asked a question and said, but wait a minute, if I took a loan once, paid it back, and I've never taken a loan again, then how does that affect my credit score? I said, at this point, that information is not yet known, because now that we have the regulation, formally as Bank of Uganda, we can now begin requiring these CRBs to put in place certain mechanisms, because we could not direct them without the regulation, okay? So, in what that question was about was saying, how does one go about growing and improving their credit score? And there shall be an awareness and public interactions around this, now that we have the regulation in place. But at this time, I will admit, it's not yet there. Like I said, this is of a development of yesterday. How will the credit scoring affect borrowers? It is actually a good thing for borrowers. It means that every time you take credit, and when I say credit, I'm not just talking about loans. It could even be a service on credit or any form of trade credit. As long as you meet your obligations under that and they are reported as such. Remember I told you that one of the things the new CRB regulations does is that CRBs are mandated to collect both negative and positive information. So the more positive information you have, the better your score. The more negative information you have, the worse your score. It's a very simple correlation, okay? So for borrowers, it is just knowing that if I enter into any obligation where credit is being provided, it is in my interest to do the right thing. Otherwise, consequently, I will suffer because it will affect my ability to continue enjoying services on credit. As for the Ponzi schemes, it's rather unfortunate And the gentleman, I think, talked about something BLQ, bet, football, something. Ponzi schemes only work because certain people or individuals, Ponzi schemes work because people are greedy. And in any Ponzi scheme, those who get in first benefit, those who get in last lose. But the question is, why should we even be looking at speculative activities? If someone comes and promises you 10% a month, unless they're dealing drugs, you have no business even listening to them. That's one. But coming back to what Bank of Uganda can do. So you are aware that recently we made, I believe it was in September, we made some changes to the Company Act in terms of beneficial ownership. We don't have full information about the persons who are behind owning some of these entities. We have also made changes, recommendations to the banks, and some of these will take effect early next year, where certain questionable accounts or questionable transactions get reported through filing of what are called suspicious transaction reports to the Financial Intelligence Authority. Who is the authority? Because technically Ponzi's tend to be about fraud and the laundering of money, hiding the source or hiding the destination. That is a mandate of the Financial Intelligence Authority, which we work with as Bank of Uganda under the National AML Task Force. Okay? So when some of these schemes are identified by Financial Intelligence Authority, they inform us and we also inform the banks, and normally those accounts are frozen. Now here is the problem. By the time someone reports a fraud from a Ponzi scheme, that is already too late. They have benefited initially, and the moment they lose and try and recover their money and go to report, that's 3 months in. That's too late. Okay? Of course, now, so if the public could be a bit more proactive, every time there's any scheme being proposed that sounds too good to be true, it always is too good to be true, report those. The Financial Intelligence Authority, that is why it was established. Once the Financial Intelligence Authority gives a directive or directs that we look into certain schemes that may be operating in certain banks, then we can move in. Okay? Because remember, when these schemes start, they are valid companies. And they open an account and the persons are known, and inflows start coming. They only become suspicious. And you remember when you sign up some of these Ponzi schemes, you've actually even signed a document that you're going to participate. So you have offered to give them money. And they have offered and willingly take it. Only when you feel cheated, you report. But again, like I said, that tends to be rather late. So for a number of these schemes, by the time Bank of Uganda gets involved and we issue directives, you only find tiny fractions of the money lost remaining on the account. That has been the issue. So Martin Luther asked about where we are in terms of the minimum capital instrument. The information I have is that the instrument was finally signed off by the Minister of Finance. We are waiting for our copy so that we can share it with the banks and get them to begin implementing. On Islamic banking, yes, in my presentation, I only talked about the MDIs. Because Islamic banking is already provided for in the law, in the amendments to the Financial Institutions Act of 2016. But it left out MDIs. So what we have done with these amendments is now say, even MDIs, especially considering the nature of the kind of people whom they serve, the demographic they serve, should also be allowed to participate in Islamic banking. And that's what essentially that provision does. So that's why I didn't talk about the FIA. I only talked about the MDI in terms of what these new amendments are going to mean for the MDIs to be able to engage in services that have largely been restricted to other institutions within the banking sector. So I will ask Babazize on the issue of controlling inflation versus growth, and Andrew to address the issue on data privacy within the payment systems.
All right, thank you. I'll respond to a couple of questions. I think if you'll allow me, let me begin with the questions raised by Martin Luther. He had a very simple question as to why an increase in CBR is immediately implemented by banks in terms of lending, of increasing lending rates, and yet I talked about a lag of 6 to 8 months in terms of the impact of macro shocks. This is a very simple conceptual issue. There is nothing wrong with banks implementing an increase in the central bank rate and transmitting that into lending rates immediately, because we expect that to happen. That is why we implement monetary policy. In fact, it would show that the channels, the monetary policy transmission channels are working effectively. Okay? But I want to make a distinction that the lag of 6 to 8 months or 9 months that I was referring to is the lag that it takes for a macro shock to fully hit the balance sheet of a financial institution, whether it's a bank or a pension fund or an insurance company. So if there's an increase in fuel prices, like the one we saw with in the earlier part of the year, such a macro shock, to be able to pass through the policy channels, such as an increase in central bank rate, in order to address the inflationary effect that it would have produced, and then pass through and affect, say, bank loans and lead to an increase in NPLs. Empirically, that tends to have a lag of about 6 to 9 months. That's why in our analysis, we're pointing out that the full effect, say, of the Russia-Ukraine war and the inflationary pressures we've been seeing, as well as the exchange rate depreciation pressures, that full effect of those shocks has not yet been transmitted fully into the financial sector. And the full effects are likely to be seen in the early or mid of next year. But we continue to monitor and will take appropriate action. Then you also asked about the reduction in the residential property prices of 12.9% and whether it could trigger an increase in NPLs. This is possible. We know that asset prices generally, not just property prices, but generally, any reduction in asset prices affects the income and financial condition of households and corporations and their ability to service their what? Their loans. Think about property developers, for example, who have borrowed loans, sell these houses, premised on a certain sale price, but then that price has dropped. What are they going to do? But that's why Bank of Uganda has responded by introducing a loan-to-value ratio limit, so that you can only borrow or get a loan from a bank up to a limit of 85% of the value of the property. That cushion of 15% is what then addresses the risk of the potential changes in property prices. And our indicators show that so far that loan-to-value ratio limit has been very effective in shielding both borrowers and banks from potential credit risk. Then there was another follow-up question. This one is about the press, that when you look at the newspapers, there are so many properties being advertised for sale by banks, and yet the NPL ratio has remained very low at about 5.2%. And why the difference? I think this one is a very simple issue, really. That first of all, I want to clarify, there was an article about 2 months ago, I think in the Monitor, alleging that banks have started selling people's what? Properties, and that the sale of non-performing assets has increased relative to, you know, they picked some outlier, yeah, about 2018 or 2019, okay? But in truth, if you look at the trend over time, there isn't much difference between this year and the previous years. But the difference that Martin Luther was pointing out is due to one fact. Under the credit classification rules that Bank of Uganda requires banks comply with, if you miss a loan payment by 3 months, the bank is required to recognize your loan, you know, as being starting to be what? problematic. So they set aside some capital or provisions. And if you continue to miss payments over 6 months up to a year, then they have to write it off. Okay? And with the implementation of the new accounting standard, IFRS 9, which I pointed out earlier, banks don't even have to wait until you have failed to pay the loan. If in their analysis you are likely to face challenges ahead, okay, then they start provisioning for the loan ahead of time, even when you are still making what? Payments. This has enabled banks to, keep NPLs lower than they would have been usually. But the other thing to point out is that even when a bank has written off a property and is advertising it in the press, they have only written it off from their loan book, but the recovery of that loan has not what? Has not stopped. It still continues until the funds are recovered, because the funds they have lent to you are the deposits of someone else. So they are required to continue with the recovery. I hope that addresses your question, sir.
When we talked about the 85, that's the 85%. There's a word missing there. I don't know what it is. Including the mortgage. When it comes, is it straight lending, come and borrow straight? Where do you think of that?
I get his question. I've got his question.
Martin Luther, are you asking what we base the value on? Are we saying whether it is market price, for sale value? I mean, what exactly? Because, you see, LTV, loan to value ratio, basically means if the property is worth 200 billion, the bank can't lend you more than 185% would be 170. That 30 million is that in the event that property loses value of up to 15%, which is quite, it's rare to have a 15% loss in value of real estate. And we're talking about real estate here. We're not talking about LTV for either shares or bonds being used as collateral or some other form of collateral. We're talking about specifically about land, and even for the purchase of land. Because imagine a scenario where a bank lends you 200 million to buy land of 200 million. Then the land subsequently loses value. You have every right just to walk away. Because even if the bank tried to sell it, the most they can only recover is 170. Okay? So it's a mechanism for reducing the bank's appetite to take on risky loans, but also as a hedge for even you, the borrower, to not find yourself in a situation where you are owing more money than the land or the collateral or the asset that you purchased.
And then lastly, I wanted to touch on the issue raised by Dr. Yaruhanga from PSFU. There is this idea that government borrowing is crowding out the private sector in Uganda in terms of credit. And I think we need to address this question. And conceptually, it looks correct, but in practice, it is not. If you look at the balance sheets of commercial banks, government borrowing from commercial banks has remained steady at about 28% of the total assets of banks over the last 10 years. It has not increased as a share of their total assets. In nominal terms, it has increased in line with the growth in the balance sheets of banks. But as a share of their total assets, it has remained steady. On the other hand, about 70% of banks' assets are composed of loans to the private sector. And this has also remained steady over time, with a balance held by non-residents. The current soft growth in credit to the private sector largely reflects other factors. For example, risk aversion by commercial banks. Many banks are reluctant to lend given that economic growth remains what? Anemic, and also that non-performing loans, are a bit high. So in this environment, banks are a bit reluctant to lend. It also reflects the fact that economic activity has not yet recovered to the pre-pandemic period. Growth this year is projected to be in the range of 4 to 8%. Last year, BoU'S indicators show it was about 4.2%. So we are yet to return to the pre-pandemic levels of 6 to or 9%. And so there are some of those challenges, but as you are aware, government and Bank of Uganda have implemented several other measures to try and spur growth. We have an agricultural credit facility and a small business recovery fund arising out of COVID. We implemented the COVID-19 credit relief measures specifically to enable banks some room so that they don't have to take on additional NPLs arising out of the COVID-19 period and to support growth during that period. The CRB amendments that Dr. Twine talked about earlier, all of which are meant to improve the creditworthiness of borrowers. The idea being that if I'm a good performer in terms of paying my loan, I should have a lower what? I should be able to borrow at a lower rate. Also coordinating with government to reduce the large overhang of government arrears, a significant part of which are owed to banks. And government this year has, I think, paid almost 660 billion in terms of clearing domestic arrears, and many other policy initiatives, some of which I will not go into at this material time. But I think that addresses some of the questions I was tasked to answer, and I hand over back to Ralph.
Just before Andrew comes in on the issues around data privacy and safety within the payment systems, I noticed my colleague from PSFU kept referring to fiscal policy. I just wanted to correct you. Bank of Uganda is responsible for monetary policy. Fiscal policy, which is about the income management of revenues and expenditure by government, is under the Ministry of Finance.
I just wanted to ask a question, might not be related. Do we actually have a trigger point at which we know that we are past pre-pandemic? Because it seems to be a never-ending position. Have we managed to figure out a point at which we can actually say we are now recovered? Is there a number?
I'm going to give that to Doctor to come in later because I want to give the floor to Andrew to talk about our data privacy. Andrew?
Thank you. There are two questions I will speak to. The first one, the question of data privacy and stakeholder collaboration. I think this is a good point that you make, and I think to a certain extent we do agree with you. There should be a mechanism, to foster this stakeholder collaboration on data issues. But again, we have to be very, very careful because the Data Protection and Privacy Act 2019 has some very, very strict provisions in terms of protecting personal data for the individuals. So whereas there might be room for possible collaboration, it has to be within the constraints of that law. And the law has very, very stringent provisions around data, including, of course, acceptance by the data subject, the data owner, and things of the like before their data is shared. The law also establishes a data protection office, which is very well provided for in the same act, and this office has the mandate for coordinating data matters. So within the constraints or within the provisions of the Data Protection and Privacy Act, I think stakeholder collaboration might be accommodated, but only to the extent that there are no breaches. For example, he mentioned, the EDS mentioned on what is happening around the banking sector. That is some level of collaboration with the banking sector able to validate ID data with the national identity database. To that extent, yes, there is room for potential collaboration, and I think we take the feedback. This is a discussion we shall pursue further with the National Data Protection Office to see whether there is some more synergy that can be harnessed without breaching those regulatory provisions. And it's not only for PSPs, it's, I think, a discussion for the financial sector as a whole. The last one, which came from, I think, Martin, it was about data. Yes, I did share some data. I shared numbers between June 2021 and June 2022. The September numbers, we still have a few validation processes that are still happening. But for your comfort, I can tell you that across the platforms, both wholesale and retail, the growth trajectory has continued. And I can tell you, for example, on the retail scene, for the year ending September, we are looking at about 161 trillion in mobile money turnover or transaction value, 161 trillion for mobile money over the 12 months ending September. And that reflects 30% growth if compared to the same period in the preceding year. If you look at the quarter to quarter, growth is about 6% between June and September of this year. Agent banking, which is another retail system, for the year ending September, we're looking at about 27% increment in the transaction value. And in terms of RTGS, obviously, this is the wholesale side of the discussion. Over the same period, we're looking at more than 600 trillion in transaction value, reflecting 21% growth if compared to the same period in the previous year. So the numbers are very, positive in terms of growth, and we see that across both wholesale and retail systems. The related question around what the payment service providers are doing in terms of public education, very good question, but also one that you need to put into perspective. The obligation for them to do this is not even 2 months old, because it's all in the recently gazetted National Payment System Consumer Protection Regulations. Okay, so it is a new law, it is a new requirement, but even then, there has been some some ongoing public awareness. You might have seen or even heard the messages on radio between August and October. There was a lot of electronic media public awareness under the auspices of the Payment Service Providers Association. There were messages running on radio around mobile money fraud, and on TV, I did see them as well. There was also one we conducted in conjunction with the UCC. It was called the Tom Ferrer campaign. Again, there were lots of videos doing the rounds on electronic media and to some extent social media. So you are right that the PSPs need to do more in terms of digital literacy, but the requirement is a fairly new regulatory provision, and I'm certain that you'll see a lot more of this as we start enforcing these provisions. Thank you.
Yes, just to add on to what Andrew has said, while we are correct to have expectations on the payment service providers, the commercial banks, the credit institutions, the MDIs, the e-money issuers, in terms of trying to help protect us against fraud, in the final analysis, the management of fraud comes down to us. Like I said, the only reason why Ponzi's work is because they work on someone's greed. And as a rule of thumb, if something sounds too good to be true, it probably is. So if banks are lending at 20% and someone is promising you 10% a month, why does he need your money? He or she had better go to the bank and make a fortune, right? Why do they need your money? The payment service providers, yes. And Bank of Uganda, yes. And the other financial sector regulators, yes. Financial Intelligence Authority, yes, we have a lot to do. And yet we must continue to do more in terms of awareness. But then also the other question, which is also mentioned in our Financial Consumer Empowerment Guidelines of 2011, you also as a consumer need to be aware of your rights and your obligations. And controlling or stopping fraud, whether through Ponzi's or any of these other schemes, also requires the participation of the individuals. There's only so much we can do to protect you from yourself. I don't know if that makes sense. But if you think about it, we can put in place the laws, the penalties, and the requirements on all these entities, but in the final analysis, however well good all those laws are, if the individual makes a conscious decision to ignore those and say, after all, Bank of Uganda protects me, and still engage in risky behavior. There's only a limit to how much we can help. A chain is only as strong as its weakest link. Unfortunately, we as individuals, by very definition, we are inherently prone to failure. We are the weakest link within this system. The next, I want to address the issue that was raised by Badru. Is there a point where we say we are post-pandemic, or that we have come out of the pandemic? Let me just give you one simple statistic. Private sector credit prior to the pandemic was an average between 12 to 15% per annum. That was the rate of growth of loans to the private sector. Today, that number sits at 4%. The question then is, shall we get back to 12 or 15%? I don't know. Maybe we might set out a new standard of 10, maybe. Okay? Because unfortunately, the pandemic and its effects is not like when you get flu, and at some point the flu is gone. There's no question about it, it's gone. This one tends to be, have like simmering long-term events. It's like, you know, that perhaps might take 3, 4, 5 years to finally work themselves out of the system. I think the more important question should be is that at what point do we get back to and say, now we are on the road to recovery? You remember during the pandemic when we had the lockdown, there was this whole argument about V-shaped, VW-shaped versus U-shaped recovery. That, you know, you come down, get to the bottom, and begin to go up at the same pace. You might go up at the same pace, you might go up at a lower pace, or you might go up, they come down again and then go up again. That's the W shape. If we're dropping at 10%, there's no guarantee that we have to recover at 10%. Because again, the circumstances there, we didn't have Ukraine, we didn't have all these fewer things going on. So the circumstances at the time of COVID have been either worsened or exacerbated by other developments over which we have no control. So is there a point where we will say we are post-pandemic or we have gotten out of it? I think your guess is as good as mine. I think the bigger focus should be on, have we hit bottom first and foremost? Because we have to first hit the bottom before we start coming up. Because if we haven't hit bottom, that means we are still on the slope. But when we hit bottom, then we start coming up. And I would like to believe that we had begun the process of coming out. And then other things have come up, which have slowed down, and he talked about, the phrase he used was very interesting. He said, anemic growth. Anemia is when you have, you know, a little blood, right? You're not dead, but it's little. So the recovery is slow. We're hoping all these things that we do, the intention is that we pick up pace. But as we're trying to pick up pace, then inflation comes in. Then Dr. Biarogavan and PSFU the director get worried. I said, but the things you're doing to control inflation are affecting us. And I say, yes, because we have a choice to make. We can try and make sure you remain and then have no economy to talk of, or we control this inflation. It is easier to recover economic activity than it is to try and reverse the long-term negative effects of inflation.
Okay, thank you very much. Can we please give our panelists a big hand clap? Thank you all for taking the time to answer these questions. So as we come to the close, final item, please let me invite Rita to give us a vote of thanks, and we'll close for the day.
Good afternoon, everyone. Thank you, that's much better. My name is Rita Biarogavan, economist in the Communications Department, Bank of Uganda. So on behalf of Communications Department, Supervision Directorate, and Bank of Uganda in general, I would like to thank all of you for taking part in the second Financial Stability Symposium. To our colleagues in the media, thank you very much for always responding to our call to you to come and take part in these events. I would like to also thank Mr. Badru Ntege, the board member at Private Sector Foundation Uganda, Dr. Julius Biaruhanga, the Director of Policy and Business Development at Private Sector Foundation Uganda as well. I would like to thank staff of Government Citizen Interaction Center, all Bank of Uganda staff, especially Dr. Twine, Robert, Ivan, Sophie, Andrew, Martin, Sarah, Martha, and Dawn, who have represented their different departments, and of course the entire team from communications who have been physically present today. And for our online audience, especially Bank of Uganda staff and all our stakeholders, we appreciate you for being part of this event. Like Ralph has highlighted, the presentations are available online already. They are on the Bank of Uganda website. Kindly look for financial stability. You'll find a link in there that has all the presentations and all the speeches that have been delivered today. We do hope that today's symposium has imparted new knowledge and has corrected any misinformation that has been circulating about Bank of Uganda. We also do appreciate your feedback, so kindly fill out the evaluation forms and we'll collect them in a bit so we can do better next time. And when we call upon you next time to be part of this, kindly come through and do work with us. Once again, thank you very much for taking part in this symposium. We wish you a very beautiful afternoon and the rest of the week. Thank you very much.